plane, they're ready to take off, and yet they just can't find any money. And that's basically where we come in. Now, what are angels? And so we all come from that world. But let me start from the very basics. I mean, professionals, ex-entrepreneurs invest in their own money, do not take majority participations, and they invest alone as part of networks. Now, 99.9%, don't quote me on that stat, are not full-time investors. Most people, or most angels, have got a real life on the side. The entrepreneurs, they retire, they have a job. Very, very few angel investors are full-time investors. We are full-time investors. And the motivation for people just varies greatly. Not everyone is completely focused on making a return. My group is focused on making returns, and for me, it is the most profitable asset class as long as you do things properly. And I'll come back to that a bit later on. Some people, it's a very tax-efficient way to invest. The government is participating. The UK, for example, has got a pretty popular scheme. It's a way for some people to be keeping up to date with certain trends in certain industries they're interested in, or just allow people just to have a very socially interesting life. It does bit talking about, it's always more exciting talking about the latest artificial intelligence investment as opposed to the latest flash you got in the neighborhood. And for a lot of people, they want to have the feeling of being useful, of giving something back. It's not just being driven by returns. And that's very important when I come back to talk about that difference with the venture world. And most angels, as you know, are part of angel networks, and these days there are thousands around the world. Now, you have also... Okay, can you hear me?
Yes.
All right, thank you very much.
Oh,
the camera can hear me. All right. So, and of course you have what we call the super angels. So super angels essentially are large angels, investing large ticket size, and they come in all sorts of shapes and forms. Some of them manage small funds, some of them are cashed out entrepreneurs, some people put clubs together, and we feel within that category. Now, here's a few numbers to make you really understand what this value of depth does exist between the angels and the venture world. Now, here's the EBAN stats. So last year, actually 2017, the average ticket size in Europe for a business angel was 25,000 euros. That was the average throughout Europe. In the US, it's about $32,000, so just barely more. And the average ticket size in Europe for a group of angels, so an angel network investing in a single company, was 182,000 euros. Right, so a group of angels getting together, investing in one company. The average in Europe is 182,000 euros. In the US, it's been more than 300,000 US dollars. And the average annual investment for an entire network in Europe is 1.5 million euros. Right, so these are averages. Some do more, some do less. Now, on the other side, you have the venture world. Professional managers, and they are managing third-party money. Most of the time they have to invest some of their own money in the funds. They're charging a fee structure, management fees, performance fees. They very often start investing, when the letter starts, the Series A, B, and C's, so you have more and more, micro funds. But I would say the good global funds, the one that will help a business scale globally, will not invest unless they can deploy a few $1 million worth of capital. Now, they've been gaining a poor reputation, I would say, over the last 10 years for all sorts of reasons. The first thing is that their interests are not aligned with the entrepreneurs and the angels and their own clients, for that matter. In the sense that they're very often seen coming in with terms that are just very challenging for the entrepreneurs and the angels. They often claim they will help and assist build a business. The reality, most of the time, they just don't. And sometimes there's a complete lack of understanding of the businesses themselves. Not all of them are sophisticated. Of course, there are some great venture funds around, but on average, I think the average is just not very high, and they have gained really not a very good reputation over the years. So the benefits of the angels, the benefits of the private investors, is that interests are seen as a lot more aligned. An entrepreneur will see a business angel a more
a lot more like him or her, being a private individual with some experience, bringing in money, trying to, most of the time making returns, but also trying to help the businesses grow. So these benefits of the angels that they've been seeing as being very helpful and smart money, and a lot more aligned sometimes than venture. So, and I'll come back to that. But so there are various definitions of the value of death in startups. And some say it's the entire period before a company is breaking even, but I would define it as a gap that exists between the money a regular angel invests, which is 183,000 euros in Europe, and where the VCs really start coming in. If you think about a company looking to raise €1 million, on average in Europe, it would need 40 individual business angels. So you need €1 million, you need to convince on average 40 individual business angels, or you need to convince a VC who will tell you, it's great, come back when you need $3 million, $5 million. That gap is the value of this. So it's typically the stage where we start investing in. So we're probably a group of investors. We typically invest minimum of $500,000 when we're coming into a deal, but our regular ticket size is anywhere between $500,000 and $2 million. And this is really the area where most companies struggle to get their first financing, their follow-on financing. Typically, the proof of concept has been made, the company really needs cash, and is ready to expand. And it's an incredible opportunity if you are able to deploy that amount of capital and help your businesses grow, because you basically find businesses that are ready to take off, and they're really struggling to find money. So a few words on how I come to be a business angel and how I saw the opportunity just to do what we're doing now. So I come from the finance side. I'm a former investment banker, and I worked in London, Paris, Tokyo, Singapore, Hong Kong for big international bank. And the last job I had, I was the head of investment banking in Asia Pacific for a European investment bank. I started working about 10 years ago, starting Monte Carlo Capital, essentially to invest my own money in private deals. And I looked at the early stage investment space as possibly the most interesting space, potentially generating the largest return, with a caveat that it's probably the most difficult asset class to invest in, the most risky. And I think most of the time when people start, the place where most people actually do lose money. So the opportunity I saw is the following. I could find great businesses at great prices by really focusing on the value of this. These businesses went through the friends and families, the angels rounds, too early to find VCs, ideally avoiding VCs, and basically couldn't find any financing. As again, it's a problem around the world, including the US, and we invest a lot in the US. That's the first thing. The second thing is I wanted to be able to scale up investments as an early stage investor. It always strikes me how angels essentially tell their companies and know how to scale up. The funny thing is that angel investment itself is a very hard activity to scale up. So most angels are struggling to scale up their activity. Either you raise more money, but then you're not an angel anymore, or you do more investments. So as opposed to doing 3, 4, 5 a year, you do 10, 20, 30, but then you're not doing a good job. So how do you scale up being an angel investor? Most angel investors end up being VCs. But once you become a VC, you're like one of a thousand. So you're losing completely your edge. So scaling up early stage investment as an angel is the thing that most people are struggling with. For me, I will explain to you how we did it, but we're scaling up early stage investments as private investors. So what I found is that if I could build a group of sophisticated investors and family offices and advisors around the world with a similar structure as a venture group, I could basically bring together the best of both worlds. We'll be a group of private investors, global, looking for big ideas, and having the ability to deploy an amount of capital that only venture funds can deploy. And that's basically what we've been doing. And if we could do that, we could find incredible businesses. So here's basically how it works. So we invest anywhere between $500,000 to $2 million at this stage. I lead every investment in my group, but occasionally I co-invest if there's a good lead investor. But most of the time, I'm the lead, and we're taking the entire financing. We invested as a private group investors close to $20 million last year only. And the structure that I put in place is a structure that was designed to be very investor-friendly. So essentially, we don't charge management fees, but we take a carry on the upside. So I pay for all the running costs of the operations, and we need to tackle the upside. We only target exits in the hundreds of millions of dollars, so we're looking for big ideas and big opportunities, which typically sometimes just worry about the angels because they know they're going to have to invest quite a bit of cash. And as businesses grow, we're bringing in other later stage investors, usually families that prefer to invest in later stages. So our businesses have raised about $150 million over the last 12 months only. These are businesses that mainly we seeded. And I reckon we will need $50 to $100 million a year to keep funding our businesses. So essentially we're doing two things. The first thing is we're launching SPVs. So as opposed to us just investing directly, to bring in more family offices, setting up dedicated vehicle, essentially where family is investing in one vehicle that itself is investing in one company. So that's one thing we're doing. And we're probably going to launch a follow-on investment fund as well. So the idea is that the fund, which would be a traditional venture fund from a structural perspective, will be dedicated to investing only in the deals that we're involved with. And the idea essentially is, in the end, I want to be able to fund our base businesses all the way to the exit. So essentially taking the businesses when they went out through the seed round, typically the angels rounds, when they're ready to take off, when they're struggling to find investments, when the ideas are big and highly transforming, and investing and keeping these companies within our own group and being able to fund them all the way to the exit by bringing a global support, opening doors, bringing clients, and so on. Now, when I started, the question that went through my mind is, I've been essentially investing and run businesses pretty much through every asset class. So when I was running the bank out of Asia, I was running all the trading floors in Asia Pacific. So anywhere from the equities to the currencies, alternative investments, commodities, and so on. And yet I was investing in early stage companies. So the first thing that went through my mind is, doesn't really make sense having a skill across most asset class and yet investing my own money in separate areas. And I always work on the assumption that actually you can generate substantially higher return if you can control the deals. If you can source your deals, structure them, and influence them all the way to the exit, you'll be generating substantially higher returns. It's always been my own experience. Now, I was interested in seeing what kind of studies were done in the early stage investment space. How successful are on average business angels? Empirically, the feeling I always had is that when people start, they lose money. When I started investing in early stage businesses, probably nearly 20 years ago now, I lost money. I did absolutely everything wrong. And the sense I was getting is that most people who start investing in startups basically end up losing money. It's only over time that you're really starting to understand how to basically invest and get a chance actually to generate returns. But I was interested in finding out how people do on average. And there are very few studies that have been carried out. Of course, private investors don't have to essentially reveal their returns. But there were 4 research that were carried out, 2 in the UK, 2 in the US. The most interesting one was done in the US. It was done by the Kaufman Foundations, probably the largest foundation in the US focusing on entrepreneurships. And they actually published a very interesting research on angel investment and venture investment as well. Actually quite supportive of the angel world, pretty critical of the venture world. Both research really was to read, and themselves have been investing for a very long time in venture funds. And their research really was very interesting. And it's probably the most interesting research I found. Now, the 4 research were looking essentially at a group of angels, angel networks that were reporting their returns over a long period of time. And the 4 research were showing median IRR that ranged from 18% to 54%. So the low-performing group was generating IRR of 18%. The high-performing group was generating IRR of 54%. So of course, by investment standard, these are high returns. Now, there are always questions about self-reporting. People don't want to share performance that are poor. So I'm not sure how reliable these things are. But what was the most interesting is that they were looking at, the Kaufman reports was looking at the drivers of returns. So what makes the difference between a high-performing angel and the low-performing angels? Now, the studies they'd done was over a bit more than 500 angels, over more than 3,000 investments, that was realized between 1990 and 2007. So it's dating a bit now, but I think the numbers are interesting. Now, these are not, I would say, full-time investors. These are regular angels, so reasonably seasoned, not full-time, but not beginners either. Now, here's the results. So the median IRR over the long term in their study was 27%. Now, about 61% of the investors made more money than actually they invested. Now, here the thing that's the most interesting to me. What are the drivers of return? The single most important driver of return is due diligence. So in the study, those that did more than 40 hours of due diligence had a median return on investment of 5.9 times their money. 5.9, okay. Those that did a low amount of due diligence, defined as less than 20 hours, had a median return on investment of 1.1 times their money. So high level of due diligence, nearly 6 times their money, a low amount of due diligence, barely 1 time their money. Now, anyone coming from the investment world probably would think that this is quite not an unexpected finding. But the difference between doing a lot of due diligence, a small amount of due diligence in early stage investment is massive, okay? The other elements they look at is the expertise you have in the industry. So the higher the expertise, the higher the return. But it's not as important as the level of due diligence you're doing. And the third element they're looking at is the level of participation you have after you invested. The more you participate in the business, the higher the return. But again, the single most important driver of return is due diligence. So some of the conclusions was, of course, do your due diligence and diversify. I typically say that you need to at least have 10 investments in your portfolio to at least hope to have some sort of minimally diversified portfolio. And I think the reason why most angels lose money, I think there's also reasons, but first of all, most angels start because they receive, they're not experienced investors, so they receive an email from a friend and the idea looks cool, we're already in the newspaper, all these tech billionaires, I want to be in it, I'm going to invest, and of course I never see my money again. So I think this is the way most people actually start. That's why I started 20 years ago. A friend sent me an email, the guy was really cool, he was very smart, he was very good at what he was doing. I invested twice, I never saw my money again, and I just realized that he was not doing due diligence properly. As simple as that. So over time, I learned with my own money how to avoid these kind of mistakes. The other thing that people are doing is they're not diversifying enough the portfolio. The first 3, 4, 5 years are the most difficult when you invest. So of course, if you want to build a diversified portfolio, you have to keep investing. But as soon as you start investing, problems start to appear. I mean, every business you're investing in has problems. I mean, the business that don't have any problems, from my experience, just don't exist. So you start investing, you know you have to build a portfolio over time, you know it's going to take you, a few years, and you start investing and things don't go according to plan, there's delays, and you're thinking, wow, am I going crazy here? What do I do with the rest of my money? Do I keep investing in? Do I stop investing? If you stop investing, that's it, diversify, you will never make any money out of this asset class. If you keep investing, you need to be very comfortable that you're doing the right thing. Of course, once you start seeing your first exits and you start paying for your initial investments, this is when you are, of course, in the money. But the first few years is the most difficult when you start investing in research companies. Now, there's one element that was not considered by the Kaufman reports, and the deal flow. Because, of course, the more deal you're seeing, the higher the quality, the higher the chance of finding the right deal. So here's how basically we got organized. This is how we're looking to be the best of the angels world and the venture world put together. So the first thing is the deal flow. So I see about 1,000 qualified business plans per annum. And I say qualified, it's essentially from people that I would know one way or the other, and they would have put some first level filter to what they're sending me. I'm just ignoring the constant emails I'm getting through LinkedIn and all sort of different means through my inbox. And the key to be able to see that deal flow essentially is building a reputation. You have to build a brand so that the deal flow just reaches you. It's absolutely critical. Because you want to show a few things. The first thing you need to be able to demonstrate, you need to show to the entrepreneurs that you have the ability to invest and you have the ability to help the businesses all the way to the exit. So I spend a lot of time working on my deal flow. And I do that in just very numerous ways. I mean, EBAN is one example. So I joined EBAN probably 3 years ago, and I won the award of the best performing new member of EBAN just the same year. I joined the board the last year as well, and I've been judging many business plan competitions. I'm speaking at conferences pretty much around the world, Asia, Middle East, Europe, US, just last year. I'm on the board of the Venture Capital Association in Monaco as well. And I teach, so I'm a adjunct professor at the University of Monaco. I teach venture capital, and I've been giving classes in various business schools as well. But teaching is something I do more for pleasure than anything else. I teach MBA students. And I have advisors based around the world, anywhere from the US to Asia and Europe. And advisors have skills in very specific industries. So we've got 2 people, for example, in pharma, biotech, medical devices, who help me with deal sourcing, due diligence, and people I can bring on the board of some of our companies. I got somebody based in China helping with manufacturing for tech, for example. Some of the CEOs of some of our portfolio companies are advisors and so on. And then we have investors also that are bringing lots of value in terms of deal flow. Most of them are either seed entrepreneurs, hedge fund managers, family offices, and so on, who open doors, introduce all sort of peoples. So all of this essentially is bringing visibility, and through the visibility, I get contacted, and through all these thousands that I get, every year, I basically am able to find those little gems that I'm looking for basically all year. I will add something else as well, part of our deal flow. It's a partnership I've had, and I built over the last 3 years now, 2 years and a half, in the US. There's about $70 billion a year going into grants, R&D in the US. And hardly on this money, any of the IP created through these grants gets commercialized. It's a problem that is global. Essentially, a lot of money being given by government and also the body to universities, funding some of the best researchers in the world, and then essentially files with incredible IP sitting in a file somewhere and no one ever doing anything. To me, it's a gigantic bottleneck to the creation of wealth and prosperity around the world. And some groups have been trying to deal with that issue. Essentially, having universities create incubators and investors and angels trying to back inventors. Sometimes it works, but it's very challenging. It's not because you've got 3 PhDs in biotechnology that you'll be a great entrepreneur. So I've teamed up with a group in the US, essentially has been sourcing intellectual property from universities, but actually building businesses themselves around that. So there's about 22 guys now. Essentially, his job is sourcing IP, doing due diligence, and actually setting up businesses. I love the model. I did the due diligence, and they've launched 10 businesses so far, and my group is a lead investor in 8 of those businesses. So we invested a lot of capital in these businesses, and we've been working very well together. And we launched recently a small fund that we're going to close very soon, where we're actually looking to build another 10 to 15 businesses in the US in the next 3 years with the same model. Is what we call deep technologies, i.e. just essentially businesses backed by intellectual property. For me, I've signed a first right of refusal on all these businesses from a financing perspective. So we're going to find and found these businesses around intellectual property. And now we have the first right of refusal on every single financing coming out of these businesses. So essentially it's a way of securing some of our deal flow as well. Now, the next question is, you're seeing 1,000 deals. How do you choose the 5 that you're actually investing in every year? And we invest in about, I would say 3 to 5 a year. So there's always a debate about, what matters most. Do you want to back the jockey? Do you want to back the horse? Or do you want to back the market? Do you want to back the entrepreneur? Do you want to buy the technology as a market? It's always a debate which one is most important. It's always a surprise as a debate, because for me, really the 3 are very important. So the horse. The technology. So we look typically for two types of businesses. One is what I call businesses that are backed by unique intellectual property, businesses that solve a big problem, that have a know-how that no one else in the world has. Is what we call it's what we call deep tech. So in that space, you got biotech, pharma, medical device, IoT, robotics, artificial intelligence. So if you actually manage to find, if you have businesses that are solving big problems backed by IP, I find typically it's a lot easier to make to make money because you have a market that is there already for you. We also invest in a highly competitive. When we invest in competing businesses, we're looking for the smart guy in the room. We're looking for the business that will disrupt an industry faster, cheaper, better. And if we clearly haven't identified who's going to disrupt an industry, we simply don't invest. I would say 75 to 80% is deep tech, and the rest is highly disruptive businesses. In all instances, we're looking for something that is unique that no one else does. I basically don't like to invest in businesses that are doing the same thing as everybody else. Typically, I say like painkillers, don't want to invest in vitamins. And we don't want to invest in businesses unless the exit potential is in the hundreds of millions of dollars. And I mentioned spin-off of universities, and they clearly fit into those criteria. Now, talking about the jockey, here's about the team. We're all talking about the team. That's something that's the topic that comes back all the time. Typically, we say that a great team with an average idea will always find a way to make a business a success, whilst an average team with an amazing idea will always find a way to mess it up. So of course we're looking for amazing teams. Typically it's one tech guy, one sales guy. One of them has to be a clear leader. Occasionally we back first-time entrepreneurs, but typically we want people who've got significant experience, or the whole team needs to have significant experience. It's simply less risky. Also looking for a very big opportunity. So when we invest, we're looking for a very minimum targets investment return of 20x. Usually we're looking for a much bigger opportunities than this, because I'm leading the first financing, but I'm typically also leading the next financings as well. And therefore, we need to ensure there's significant upside for the investors coming as well in the following rounds. Of course, we're risking our capital every single time we invest, and therefore we need to build a portfolio because some of them are just not going to work out. And we're looking at 3 to 5 years exits when we come in. Of course, there will be delays, and the reason why we need to have a clear plan to exit is to account for the fact that very often there are going to be delays. So when you apply this level of this first filter, 95% of the companies already drop out. Most businesses don't do something that is unique in the world, that have an intellectual property that is very strong or highly disruptive with an incredible team of big markets. Just 95% of the businesses just don't fit those criteria. So once you've essentially selected those businesses that may fit those criteria, the second thing to do is a due diligence. And I do a significant amount of due diligence every time we invest, and I mentioned some numbers earlier. It is really the key driver of return. So the first thing is actually understanding what the business is about. It's always surprising that CEOs can't actually articulate what's special about their business. Typically, it's very technical in the way they approach things. They are so involved in their business that they can really they're struggling to articulate what's special about it and what their clear edge is. So the first thing is obviously trying to understand what's very special about the business. Once you actually understand the business and you've done your competition analysis, you understand the team and so on, the second part of the due diligence is actually checking that everything you were told is actually true. So there's a more legal due diligence on the back of that. And now, for example, recently I've led an investment, and now we're going to do the third financing in the same company, spin-off of US university, one technology, 4 businesses created on the back of that, licensing agreements between the companies, licensing agreement with the inventor. So I had to go through all these things, actually renegotiated licensing agreement with universities, and after a couple of months of discussions, I managed to have a structure that I thought was clear and investor-friendly enough that we decided to invest. So sometimes you need to do a lot of due diligence also on the legal and the structuring side before investing. And the advisors here come very handy, particularly those that have very specific skills or expertise in an industry, essentially just to guide you. So we're using our advisors quite a bit. The next thing is evaluation. Now, valuation is more of an art than a science in early stage investments. And at universities, I go through all the valuations for about 2 days with our students. Now, of course, the earlier the stage, the less of a business you'll have to look at. And here's where I tend to look at valuation. And again, it's really not an art. Sorry, it's really not a science. The first thing is the experience of the team. The less the experience, the greater the risk, the less I'm willing to pay. So we occasionally invest in first-time entrepreneurs, but it's really reflected in the valuation of the business. We're looking for a big market opportunity, really like 20x minimum in over 3 to 7 years after expected dilutions. Most companies experience delays, and they'll need for the funding. So we will look for very big returns. And of course, the bigger the opportunities, the bigger you're willing to pay. How much money has been raised so far? The more money has been raised, the higher the dilution, of course. The more the amount of money expected to be raised, financing is always a risk, particularly when markets are very uncertain. This is one of the biggest risks in venture and early stage investments is the ability to keep financing your businesses. So how much money would be needed to go all the way to the exit? Comparables is really important as well. At the exit. So I'm looking at what kind of returns we can get, what kind of valuations similar companies can obtain on exits. If I manage to deliver my business plan, what can I expect? Is it a $10 million business? Is it a $1 billion business? So we're looking at comparables on the exits, and of course it depends depending on the changes depending on the industry. I'm looking at the solidity of the plan. Some people say business plans are meaningless in early stage businesses. I just can't disagree. I can't disagree more than that. I think business plan is very important. A business plan is reflections on the thinking that went through an entrepreneur. And I spend a lot of time looking at financials. The financial model is a true mirror image of what's going on in the mind of the entrepreneur. A business plan, in the end, with a lot of words on a piece of paper. The financial model is just an entire reflection of what people have in mind. What is the timing of things? How many clients am I going to get? What is my conversion rates? How much money I have to spend? When? What kind of guys do I need to hire? How much I will need to pay them? So although it is very rare to see a financial models or a business plan met going forward, it is a clear reflection of what the entrepreneur has in mind putting his business plan together. And I do spend, when I'm doing my due diligence, a lot of time going through the financial model with the entrepreneur, really to understand and question most assumptions. And this really helps me understand what the entrepreneur has in mind. So I don't understand why. So the fact that in 99% of the time, the entrepreneur won't need to be able to match his business plan or the financial model is not the reason why you shouldn't go through it when you invest with him, because it helps you understand what he has in mind. Of course, I'm also looking at how much money has been spent so far. The more money has been spent, the more I'm prepared to give credit to the early stage investors. Of course, the later stage, the more milestones are being met, the more the premium I'm prepared to give. In the areas such as biotech, for example, you've got some very critical milestones in terms of human trial, for example, FDA approval and so on, that make a massive difference. And I mean, typically we don't invest. We're also looking at, because we invest at seeds, the typical valuation range from $1 to $20 million. I would say $5 or $6 million, sort of the valuation we come in. If you think we're putting $500,000 to $2 million when we first come in, the $5, $6 million valuation is typically where typically got in. Now you basically have done your due diligence, you have done evaluations, you like the company. Then comes the deal structuring. So as I mentioned earlier, I usually lead the investments, which means that I negotiate terms with the company. And pricing is not everything. The deal structuring is very critical as well. We invest quite a bit in common stock, more common in Europe than in the US. We ask usual rights and warranties when we invest. Preference shares, a bit more common in the US. Typically ask as a lead investor, place on the board. So usually I'm on the board, but increasingly either I appoint somebody else on the board, or I keep an option open to appoint somebody else on the board. Convertibles, they're okay as an investor because typically they're a lot quicker to execute, but I only do it if there's a cap on the valuation. So typically I need to be very clear, I need to be comfortable to invest at the valuation cap, and then I'd be happy to look at a convertible. I don't invest in a convertible if it's just a way for the company just to raise a cap and basically have money at the higher prices. I'm just not interested in that. Now, once we invested, the way we work is the following. So, I'll be the first money into the companies, and then I turn to my co-investors, and they just tag along. And currently, they invest directly into the companies. And the SPVs that I mentioned earlier essentially are an added are a vehicle that are being used for larger size tickets. So typically we're looking at $3 to $4 million as a minimum SPV size. Otherwise, just the cost of running the SPVs are just too large. So then we invest, and this is when the real work starts because we have to help our businesses. So I typically appoint somebody on the boards, as I mentioned earlier, or myself on the boards. All businesses have got gaps, so essentially using our ecosystem to help the businesses grow. Advisors, investors, other portfolio companies, and I'm typically the most active non-management member with the company, helping with essentially the strategy, introducing clients, potential partners. I'm flying, for example, to Riyadh this last couple of weeks because we were looking at a financing for our business, and one of the investors actually, I don't want to invest, I want to buy your company. So I said, okay, well, so we'll just go and have a chat. So basically, we're very active all the way from the investments all the way to the end. So corporate strategy, funding, bringing CFO, CEO, helping with manufacturing, introducing clients, partners, and all the way to the exits. And the reason we help a lot essentially is we're increasing our chance of success when you're investing. Exit-wise, the M&A is really the most likely. We have a few businesses that are considering IPOs because again we invest in businesses that are a bit later than most angels investing. We're looking at big opportunities, and therefore some of them will be considering IPOs. So a couple we have in portfolio that are looking at IPO. We sold a business in October last year. That was running a dual track IPO M&A, and eventually we sold it as biotech business for $200 million. So essentially, if you're going back through bringing the best of angel and VCs together, for us, the reason we're being successful as investors, and I mentioned IRR, median IRR early on, we're very much higher than those levels that I mentioned earlier. The reason we had significant returns and success so far as investors, I think, come from different things. The first thing is really focusing on this value of death, because you find businesses that are really about to take off, have been through all the angels and are struggling to find money. Essentially, we have a lot of people coming to us. I've never ever competed for a deal as an investor. It's never happened to me. If you're a venture fund, you're spending your life competing against other venture funds for deals. I've never ever competed in a deal as an investor. So the other thing is being the best with your of angel and venture, which basically means having a very strong deal flow, very strong due diligence, advisors, very significant experience across sectors, anywhere from biotech to online marketing and manufacturing. Our co-investors are based in Monaco, in the UK, in Switzerland. We have some in Germany, some in Russia, with some in Asia. We invest globally, although I have to say it's mainly US based. And so far it's been UK and a bit of continental Europe. And we're helping our businesses all the way to the exit. So if you're looking at the best of angels and venture, at the same time, we're angels because we're private investors. We're a group of private investors. Our interests are completely aligned with our founders, and the interests are aligned among ourselves because we're all private investors and family offices, and it's significantly more aligned than a traditional venture fund. And we are very active in our businesses, helping them grow like a business angel will do. But we're also looking to bring the best of venture because we're full-time investors, essentially, with a very clearly defined investment strategy and a clear edge in what we're doing. We can deploy an amount of capital that's only venture funds typically can deploy, and we have the ability to carry on leading our investments. And what I've been working on, and I think it's probably another 12 to 18 months to do it, I want to be able to fund our businesses all the way to the exit without having to have access to all the capital, so calling into all the ventures. And if you can do that, essentially you have the ability to source a business right, in the case of the US, right from the university when we're sourcing the IP. But most instances, when the companies are being through the angel round, then we start seeing them, and then we have the ability to take them all the way to the exits. And with the proposition we have, it's a very powerful proposition for the entrepreneurs. And of course, we're de-risking our investments substantially because we're keeping the influence and the engagement with the company all the way to the end without having to need essentially anybody else. So that sort of concludes, I think, my presentations. I don't know if you have any questions at all.
Yes.
Sure.
Two questions. One is, could you clarify a little bit more your involvement with the startups or the team or your team? Because you invest a lot of startups. If you are directly involved or you have a team to get that involved, and what type of involvement they expect from you? First question. Second is, could you clarify the exit strategy that you have for the portfolio or for each startup?
Yeah, sure. So the idea of the involvement is helping the businesses. I have to be honest, the less involved I am, the better off I am. Because the less they need my help, the better, the stronger the team is, and the more I can do other things with my life or my time. So I really do get involved whenever I feel there is a need to get involved. So in some businesses, I could have 3 calls a day when something important is happening, and I'll be jumping in a plane and spending time with the company. In those instances, I can spend 3 weeks, a month without having a call or a follow-on because, if you're investing in a biotech company and the next milestone is waiting for some human trial data that are coming in 3 months, there's nothing to talk about for the next 3 months, really. So, but the involvement really is in the strategy. So, for example, a discussion we're going to have in Saudi. Now, the company that we're going to meet in Saudi offered us to merge one big business they're buying into ours, and they want us to run it. Now, I'm going there with the CEO of the company and the chairman of the company, and I'm involved, I'm critical in the discussions in terms of deciding what we're going to be doing because we pretty much funded the entire business ourselves. So, I'm flying there, I'm part of discussions, we're all going to decide together what we're going to do. These are critical decisions where I want to be involved. And at the same time, I'm leading a financing for the 3rd time in a row. So before we did the 3rd financing, for example, the company is growing and it has a need to acquire stocks. I wanted to have financing in place for the inventories before we go and raise money. So the company went out and basically secured inventory financing. So anything that is really strategic and critical to the business, I'll get involved. Whether they want to change office or what color the walls they're choosing, I have absolutely no interest in that. So I want to be involved in areas that are really critical to the business. And I'm doing it myself. That's really important. With regards to the exit, whenever we invest, I want to have a clear view on where we can sell the business. And over time, I realized that some business we have in portfolio, also we have loved the business, the exit is not always obvious. And it takes a lot more time because, of course, if you have success with your business, you want to be able to sell it. And even if in some areas, even if you're just mildly successful, you find an acquirer. In some sectors, if you're quite successful, it's very hard to find an acquirer. So I think it's very important to have an exit in mind. We have an AI business, for example, we funded, and it's a spin-off from one of the top 10 research departments in the world in artificial intelligence. So if you do something mildly interesting in AI today, your business is worth a lot of money. because every large companies in the world, we have to be strong in AI. Now we have something we funded that has something that we think no one else in the world is doing in AI, which in AI is not common. So if we can just manage to show that what we have works and we get some mild tractions, I know the market for acquisitions is very large. So that's giving me comfort as well. But yes, there needs to be a market for acquisition. That's why we look quite a bit at exit comparables. So one way of looking at when you invest, the number of comparables you look at, the comparables of companies raising money at the same stage, in the same space, to say, well, you know, I'm investing at $5 million valuation. Is it fair? Should it be 2? Should it be 3? Should it be half? That's the first thing. And clearly, in startups, the scale of difference is not massive. You know, you're not going to get a startup raising money at $50 million unless you're in Silicon Valley and it's, you know, it's one of the Google guys just founding it, right? Most of the time, there's sort of a finite range. But on exit, of course, you know, it can change massively. So you want to have an idea of if you're executing your business plan or not, but what kind of exit you can hope for. So then you needed to look at comparables. What other businesses were sold in the similar space? What kind of pricing did they get? What kind of KPIs they had to achieve in terms of revenues, in terms of EBITDA, in terms of technology development? Did they have in biotech? Did they have a phase 1, phase 2? Did they IND approval? Did they have authorization to go on the market? So you need to have an assessment of that, and then you're comparing to your business plan. So you need to work on this on a strategy. You know. Most of the IPOs are very rare. They're very, very rare. So I think M&A is really the typical exit. Yeah. There's a question. Yeah.
Due diligence is pretty expensive. It suits the corporates, but for smaller setups.
So due diligence is expensive. I'm doing myself, so it's expensive on my time. I think one thing
but the smaller setups, I mean, how to go about with due diligence for the smaller setups?
I'm a small setup, I do it myself. So due diligence is quite complex, but to some degree it is, especially at the very earliest stage, is you know, spending a lot of time with the company and understanding the people, because the earlier stage start part is a lot of it is actually people. So spending a lot of time with people, with all the key players and understand their motivation, how strong they are, their background and so on. So you can do that directly. So I do spend a lot of time with people. I learn a lot by doing that. Then you need to do competition analysis, of course, reviewing all the legal sides, all the legal documentations, reviewing all the contracts they've got. And then we do quite a bit of deep technology. So the technology side of the due diligence is very critical. I think there's 2 elements to that. The first is that typically if you're working with some of the leading scientists, you already have some level of comfort that at least they know what they're talking about. I mean, most businesses we have in portfolio, for example, we have top 3 scientists in the world in their own space. So we already have a level of comfort that at least they know what they're talking about. And then you need to check those elements independently to some degree. That's why advisors do come very handy. But the challenge with advisors is that in the deep tech space, the level of understanding of specialization is such that it's very hard to find somebody who's got exactly the same understanding of exactly the same space at the same level. I mean, it's just very hard to find. So at some point, you need to make a judgment call on the people you're working with, the fact that they are backed with science, the fact that they have leading researchers on the back of it and technology, and need to make a judgment call. But the funny thing is that although we do a lot of deep tech, the technology side is rarely what I'm worried about. Typically, I'm not worried about tech. What goes wrong in highly technical businesses is rarely the tech, it's actually people. People and problem with funding. That's usually what goes wrong. So surprisingly, most early stage investors and angels get worried about deep tech. Actually, I love it. And they get worried because sometimes they feel they don't have the understanding of the technology. But if you work with the right people, again, tech is not always a problem. Usually it's just people. It's just the first time they're doing it. They don't know how to find an office. They don't know how to work with intellectual property. They fall apart and probably problem at home, or lack of financing. If you don't have the ability to keep financing your business, it's real trouble. The business we sold for $200 million in October we couldn't find any financing for the company 9 months before. We were talking to some of the largest biotech investors in the world, some of the more sophisticated ones. They were dragging their feet. They were asking questions. They were not sure. They didn't understanding. Eventually, the core group of shareholders put the last money down, and the investors made another 2.5x in 9 months. So everything went according to plan. We couldn't get any money in. Yeah, so financing is a big risk in what we're doing. Yeah.
How do you find the competition? So many places in the world trying to make big teams. How do you know somebody? How do you find the competition of the investment you're doing the due diligence?
So I'm really avoiding competition. So as you remember, there's two things we're looking for. A, businesses solving problems and with a solution no one else in the world has. And the other one is highly disruptive. And I really want to make sure that this is what we have. In the deep tech space, you never know what is there as a university working in this lab somewhere else in the world, working on similar tech. Again, if you're working with some of the leading scientists in the world in your business, sometimes you have to rely on them and their ability to know that's what's going on in their field. So you have to rely on that. And then you need to do some competition analysis as well. But you can go up to a certain degree, but at some point there is a risk, of course, that somebody else is working on something highly disruptive. If you're looking at a business that is changing an industry, highly disruptive, you need to understand the sector. So you need to understand the sector and see why the business you're investing in is highly disruptive. Disruptive is not always easy businesses, actually. Industries have got a lot of inertia. And if you have something that is better, cheaper, faster, and you're changing really the industry, it's not always easy. Actually, I found that typically it takes more time and more money than you think you have. So you need staying power to disrupt an industry. So deep tech, I find it a lot easier than highly disruptive. Yeah.
Yes,
Yeah.
from your practical experiences, what are the top 3 key successes factor for a business angel to invest in deep tech ventures?
Well, I think it's basically what we went through the talk at large. I'm not sure I can summarize them, but due diligence, I think, is a key to everything. Yeah. Deal flow. I think deal flow and due diligence are the most important part, I think, in the investment process. Everything else you're doing afterwards, helps, but you need a big deal flow, quality deal flow, and you need to be able to do a lot of due diligence. Yeah. These are the 2 most important things, I think, driving returns. Yeah.
And how do you engage the technical advisor?
So we have advisors. We have advisors in different areas, and I engage them. They're people who just want to get involved. They're not on our payroll. They are friends and people I met over the years who like what we do and they want to get involved. Some of them, they're just interested in getting involved for the sake of it. Some of them, may be interested in co-investing with us, and because they know how we work and they know about the way we work, we're de-risking substantially our investments. They want to be part of it, and for them to be part of it, they're providing their input. Some of them we can bring on the board as advisors of the company, so they will get some sort of compensation from the companies as well, and it's how they get involved. And so there's something in it for everyone. Everyone has got a different angle and a different level of interest. And for me, I'm happy to have a group of advisors and people with different interests and different reasons why they're getting involved, and it's up for me to be able to meet what they need in the whole process. Some of them are just friends that just want to get involved because, they retire, they made the money, and they just enjoy it. So there is something in it for everybody. Yeah. So yeah.
Are you open to investors right now? And if so, what's the minimum ticket?
Yeah. So yes, we're always happy to have more investors. As I mentioned, I think our ambition is to be able to fund our best businesses to exit. So we can deploy quite a bit of capital, but our pockets are not deep enough. So we're currently expanding our group of investors. But typically at the first stage, people invest a minimum of 50 to 100K per tickets. And I think it probably range anywhere between 50 and 500 for the first investments, depending on preferences and desire to invest, I would say. And then as a business, but when we launch the SPVs now, so the one we're working on right now is a $4 million SPV for an IoT firm, the one that we're taking to Saudi. And $500,000 is minimum ticket size for the SPVs. Because
doing it by fund.
so SPVs is like a dedicated fund, but that really is a standalone for one single companies. Yeah, so that's more like family offices and be more institutional kind of investor. But the earlier investors, I mean, typically we like to have at least 100K, but people 50 to 100K. And I'm very keen, especially at the early stage, to have added value investor. So people who can open doors, say, hey, you should speak to that guy. I have these friends who could be a client for your company. And because the more we have that, the stronger our ecosystem is, the more we can help our businesses. Yeah.
Excuse me, at what stage do you feel comfortable when you are an angel investor in a business, but you can also involve your venture capital fund?
So currently it's not a fund. It's really a group of private investors. So we don't have a fund. We're going to launch a fund at some point that will be doing sort of follow-on investments. But the idea is that we really start at the early stage, and then I lead the follow-on. So we have co-investors. So my own personal investment strategy is I want to be the first money in the deal, and I have co-investors who like to be in the first investment with me. But we have co-investors who are saying, I don't want to be the first investment. Call me in a year when you get comfort that the thing actually is working. I don't mind paying a higher price, but I want to get more comfort. And the fund will basically follow that strategy, which means we're going to be investing in the first tickets. And if business really is taking off and the company needs more money, the fund will be able to deploy more capital. So less risky if you want, and we're taking the more risk, but we're getting a bit earlier. Yeah.
But do you plan to have both in a certain business, meaning angel investing? And
yes. So the idea is because we want to take the businesses right from the beginning all the way to the end, there'll be different ways to invest for different type of investors. So the private investors who want to do 100K tickets and they want it to be at the early stage will be coming at the earliest part. But if your company needs $20 million, we're not going to raise 50K tickets from angels. So then it would be SPVs or the funds eventually they will be able to take that. So they all co-invest at different stage. And the interesting bit is that sometimes people are asking, is it better to be the first investor in the deals because somehow there seems to be more upside? So if you can actually finance your businesses all the way, you're de-risking quite a bit your investments. So yes, it's good, but at the same time, the first time you invest in a business, doesn't matter how much due diligence we're doing, it's like a first date. We're all looking pretty and we're looking saying the right thing. After 1 year, we've been dating for a year. All the cracks are starting to appear. So we're getting a lot more information, and then we get a better sense of whether we want to carry on investing. So my ability to negotiate terms, although we're focusing on its value of death, and typically the company has not financing, is actually stronger when we do follow-on. Because when we don't follow on, we've already invested, I'm already the lead investor, and they already know how much work we do for the company. And so I've been leading 4 follow-ons for the last 3 months in existing businesses. So either the second, or the third follow-on. And the typical discussions are, CEO wants that valuations, and I think it's great. We are our biggest investors. If you can get that, just go for it. But if I'm leading it, it's not here, it's here. Because we're bringing our co-investors and we're charging performance fees, so our interests are that we're getting the best terms possible. But we do it ourselves. And most of the time it's a bit of haggling, and in the end we always manage to get the valuation of the terms we want, because the devil you know is better than the devil you don't know. So because they see how much value we bring in, how much we help them, we can work together well. And every company CEO hates raising money. I mean, it's a risk, it's a distraction. If we can do it ourselves and invest, they'd much rather work with us. So the funny thing is actually, actually being second or third investors in a follow-on is actually probably is very attractive as well, because we've already tried the company, we've already invested, we know it really well, and because we're already lead, we can actually negotiate great terms with the companies as follow-on. Sorry.
You touched on the global problem of bottlenecking,
Yeah.
and can you just go a little deeper into how you do the due diligence for that? I think you mentioned partnership with I'm not sure. And also one more question: how do you go about investing in biotech specifically? Do you look for, is it like data how far in the sort of research or whatever?
So typically, I check the IP, or I ask people to ask for me, to check for me. And I need to ensure when I invest in a business that they've done their homework properly. So typically there's an IP lawyer or somebody dedicated to the IP side, and I'm checking that the IP has been protected properly. That's the first sign. With regard to the US, so there's a group in the US that we've been funding their businesses, and there is a full-time IP lawyer inside the group. And our interests are completely aligned because he's a partner, and I'm basically essentially funding all these businesses, and we're just doing this willing partnership. So there's an element of interest there. So he's actually full-time IP lawyers and checking all the IP. So there's a very strong IP policy there that I've gained a lot of comfort in. But now checking the IP is critical. And if you have a poor IP strategy, it can go horribly wrong. We have a business in Barcelona, for example, and the key know-how is an algorithm. Essentially, it's a company that is repurposing drugs, so finding new application for existing drugs, and is using an algorithm to do that, and is the most predictive in the industry. The thing is, if you start trying to file for any patent protections, of course, you're going to have to develop what the formulas are and what you're doing. And as soon as you do that, somebody's going to copy it from you. So we're actually keeping it as a trade secret. There's only 2 people who know within the company how it works, and we're not going to find anything on the back of that. Yeah. So especially in deep tech, you need to have a very clear IP strategy. And in biotech, so biotech is tricky, and a lot of people don't want to be involved in biotech. And it's probably my riskiest investments are in biotech, but I'm always looking for an angle, so I don't like risk too much. So I need to get sense that it's actually working. So the company, for example, we sold in October, it was a team working for the #1 in the world in that space that wanted to implement a new drug, and they had human data, and the company said, we can't be bothered. So they left, and they set up their own company, but they already had pretty much a lot of the results. And the plan was to sell the business within 3 years for $200 million to the same guy that they were coming from. And 3 years later, in 3 months, they sold the company to the same guy for exactly the price they had in mind the day they started the business. So because we had the best team that there is in the world in that space, because they already had data, and because they knew the guys they were working for would never let it go, when I invested, although it was a startup in single drug discovery in biotech, which typically is the riskiest thing you probably can possibly do, I actually looked at it as a low-risk investment. Yeah. So there needs to be an angle. And companies, we have one business in portfolio that says, we hope it's going to work out. It's digital. It's probably one of the riskiest investments that we have because there's a digital element and we just don't know whether it's going to work out or not. But that was something that was also quite close to me and I really wanted to get involved. There's the third business we have invested in as well. There was already data inside, for example. So there was data in another country, not sufficient to get an FDA approval, sufficient to get me comfort that the chance of success was reasonably high. So there needs to be an angle. The single drug discovery and let's hope for the best, it's not something I'm very comfortable with. Yeah.
Do you consider to buy some angels position, investing before you?
So far I haven't. Actually, we've done it once. Yeah. Actually, it's a biotech firm that does drug discovery. Yeah, we invested, the company was 7 years old, and the valuation were probably 6, 7 times, actually they were 8 times higher than where the business angels came in. But I thought there was another 20x to go. And some investors wanted to sell, were prepared to sell their position at 30% discounts to where I was prepared to invest. And for their perspective, they had made 5 times their money in 7 years. So, they wanted to take half their position out. From my perspective, it was a great deal. So we bought, all their positions. But I saw the business as having massive upside. And from their perspective, they've already been sweating for 7 years, and they wanted to take half of the money off the table. So they were happy, we were happy. And now we're working on the NASDAQ IPO, so I'm not sure if they're still happy they sold their position. But it was a sort of a win-win. We all wanted the opposite things. Yeah. Yeah. All right, guys, thank you very much for your time.